Thank you very much. After the impressive speech by Steven van Akkeren, I will limit, as requested, my remarks to some challenges to the banking industry. I would like to add, when you talk about drinking in this country, we drink milk. That is
buttermilk.
Yeah, buttermilk, even worse. It's, well, the banking sector, where are we now? Those who claim that the financial crisis is over are dangerously optimistic. I think that much remains to be done to minimize risks of a repetition of a financial or banking crisis. However, other critics who pretend that hardly anything of real importance has been achieved since the beginning of the crisis in 2007-2008 are also wrong. They are right, yes, that many mistakes have been made in banking and that still today weaknesses and irresponsible behavior in banking continues to exist, but they disregard progress, the major corrective steps that have been taken in recent years. I give briefly one example, only for the Netherlands. A recent book by a journalist, Joris Duinendijk, Dit kan niet waar zijn, the title, describes the current thinking, culture and behavior of a large number of bankers in London, which present indeed, so that is interesting, presents indeed a worrying picture, and I agree with him. However, he then makes a number of general conclusions about lack of action, recent action in the banking sector, such as, and I quote, considerably higher capital buffers would have made banks more safe, but they were not realized, torpedoed by the global banking lobby, end of quote. He is wrong, factually wrong. The facts are that these capital buffers have been considerably raised and will be raised further, and rightly so in my view. But people, when they present views, they should base themselves on facts. One of the many causes of the financial crisis, and I won't deal with them otherwise, was related to the interlinkages between financially weak banks and financially weak governments in the same country. As you know, they behaved like Siamese twins with contagious diseases. Very unfortunate. Now, what is unfortunate is that in Europe the necessary action to address this dangerous situation has not yet been taken. That should have been done by imposing reductions on excessively large claims of several banks on weak sovereign borrowers in their own country. And this so-called doom loop is still one, in my view, one of the remaining serious issues of a financial crisis that has not yet been resolved. Another quite different open end of the banking crisis where further action is needed concerns the deposit guarantee system, DGS, for the smaller retail deposits with banks. The prevailing, and as such good, national DGSs have been harmonized. That's important. But they are unfortunately not yet transformed into a European DGS due to political opposition in several member countries. So there's work to be done. Of a quite different nature is a recent development in which member countries of the Euro area have agreed to adopt certain important measures to solidify the financial strength of the banking sector. But after such European agreements, which I support by the way, some of these countries have decided on a national basis to go further than the European consensus just agreed by imposing stricter rules on the banks in their country. This so-called gold plating, that's the term, was opposed, among other things, in the report of the La Rosière Committee in 2009, of which I was a member. Now, unfortunately, my country, the Netherlands, is now engaged in this practice on subjects such as bonuses and capital requirements, such as the leverage ratio. And this leads, ultimately, to undermining the level playing field for banks in Europe, which is not a good development. In my view, the most important lessons learned and action for progress from the financial crisis are the following. One, I begin with that one, the substantially higher capital and liquidity requirements for all banks. They have already been implemented and more is likely to follow, I think. And secondly, the bank supervision has become much stricter, that was necessary, much stricter and has now become European, as you know, through the ECB rather than national. And those who are still active in banking, like some of you, they probably will agree that the impact of the recent harsh asset credit review by the ECB of all the larger banks in Europe is substantial. It was not always appreciated by the victims, but it is substantial and rightly so. So that progress has been made. And the third factor, which was very awkward, and to a certain way still is the burden sharing of financial support for ailing banks. That burden sharing has changed fundamentally. Whereas in the earlier years of the crisis, until 2012, the governments, that is you and me, the taxpayers of the countries where these problem banks are based, assumed the financial burden of these rescues through the so-called bailouts. The now prevailing arrangements of the banking union replaced these bailouts by bail-ins, in which the private sector investors in the problem bank are obliged to accept losses. That is not pleasant for those investors, but I think it is a right change in approach. Another crucial cause of the banking crisis was, and I've seen that from nearby, was related to inadequate risk management by many banks themselves, both in Europe and in the USA. Failure in this area proved frequently at the heart of serious financial problems of banks during the financial crisis. And in a bank, it's their core business. A bank must be able to have a deep insight in A, the size of the various risks which are related to its particular activities, and B, the necessary risk-reward ratio of its activities to avoid, in the longer run, a structurally loss-making model. And then thirdly, one needs checks and balances in the banking model which a particular bank has adopted. And these important, that sounds simple, but vital factors have been disregarded deliberately or through lack of experience or knowledge in many banks, not all of course. And here improvements have already been achieved, but I admit that the situation varies from bank to bank. More work therefore is to be done. And this may require, in some cases, more replacements of sitting senior managers, or not senior other managers, in a number of banks, and or, less dramatically, further retraining of bank managers to understand the real risks in their business. In connection with risk, many banks should improve the instruments to keep their risks under control. Otherwise you may have good intentions, but if you don't create the instruments, you don't achieve very much. And I mentioned briefly what is really necessary is a kind of proper governance, checks and balances, a heavily equipped manned internal controller department or auditing department with direct access to the CEO and to the supervisory board of that particular bank in order to make sure that their warnings and their voices are heard at the right level. And secondly, a competent and alert supervisory board, and particularly its audit and risk committee, which has become so much more important than in the past, and rightly so. They should not be shy to say no to management if they are uncomfortable with certain risks of proposed transactions by management. That's also a checks and balances. Sometimes you can't do it all the time, and sometimes simply saying no is the best answer. And if people don't like it, then you say no, no, but it remains no. And that saves sometimes billions of euros or dollars or whatever. During the financial crisis, not only banks made serious mistakes, as I said myself, but also, I want to highlight that, also the other major players in the financial system. So it's not such a simple black and white story. The governments and bank supervisors made mistakes, credit rating agencies as well. I must admit, the financial markets, where investors insufficiently recognized looming large risks or insufficiently required a proper risk-reward ratio in their investments. And if they would have done that timely and sufficiently, then some of these so-called southern European countries would not have run into such a high degree of well, lack of balance in their finances, because the markets would have created a halt to their, I think, wrong policies. But if the markets allow you to continue with your bad behavior, that's sometimes what happens. So the needed discipline of market forces failed. And in this context, I have concluded already years ago, I learned that lesson, that the traditional focus on self-regulation in financial markets, and that was the situation when I was young and entered those markets, and self-regulation in and by financial institutions have proven to be maybe useful sometimes, but clearly insufficient to avoid major problems. More is needed, and that is what's being done now, regulation by authorities outside the sector itself. Two aspects of the size, and that's a delicate matter, the size of financial institutions still deserve attention, and a common ground has not yet been found on that one. In the years before the financial crisis, the overall size of the financial sector had grown disproportionately as a percentage of GDP in most countries, Europe, United States, elsewhere. And I think a correction was necessary, and it has taken place. See the financial crisis. The overall size, as well as the profitability, the return on equity to which Stephen referred to, and employment, importantly in banking, have shrunk. And I think will stay on that lower level, structurally. However, on the other hand, today's world has become more and more complicated, globalized and competitive, and it needs a financial sector that is sufficiently large, diversified and international. Why? To be able, not for their own interests so much, but to be able to serve their clients, and in doing so, to serve the desirable growth of the real sector of the economy. So one should not bend over backwards and go to the other extreme and say smaller is better on the size of the financial sector. That will be maybe understandable, but I think a dangerous long-term conclusion. The more difficult question is whether the size of individual banks requires limitations. And many critics oppose very large banks with the widely heard argument of unacceptably high risks and potential cost of the famous too big to fail banks. Well, I see the point, but I prefer a somewhat more nuanced approach. It is true that after years of financial crisis, since 2007, we now observe, maybe surprisingly, a higher concentration in banking, rather than the opposite, which many had hoped to achieve in those years. Because in most countries, Europe, United States, other countries, the combined market share of the largest banks in a country, say 5, has grown. So in fact, you see more of very large financial institutions rather than less. Not everybody's happy with that, but those are the facts. However, I think that the issue of the size per se is not necessarily the stumbling block. What is more a stumbling block is a very complex bank. That could create more unwanted or uncontrollable risks, because people no longer fully understand what the left hand, what the right hand is doing in such a complicated structure. Although I do recognize the merits of the universal banking model with its diversifications of activities and risks, because diversification remains important. Recently, several measures have been taken by banking authorities in Europe and the USA, which rightly are aimed, and they have achieved that already, at reducing excessive risks that may result from certain traditional banking activities or products. Briefly, a ban on the so-called proprietary trading for the standard commercial banks, so non-investment banks, and a ban on their private equity assets and hedge fund activities, and a number of other limitations. I think that all these limitations, which I support, should lead to a more narrow banking model. However, to go much further and to go for a strict separation between what you may call utility banks, Nutsbanken in Dutch, with limited retail products, and say the other kind of banks, zakenbank or whatever you want to call it, would be, in my view, not a wise decision. I call for a more active role of shareholders in banks as a counterweight to management and board members. That's not always easy to realize in practice. Of course, it depends also on local legislation. I know that. But my focus is on important decisions in banks where things have gone wrong in several cases in recent years. Apart from items where the shareholders by definition have a say, such as decisions on the size of the annual dividend, my point is more that a more active voice and influence of shareholders makes sense in delicate areas such as remuneration of senior management, as well as appointments and reappointments of senior managers, as well as outside directors, independent directors of banks. After all, if society outside the banking sector, that is politicians, media, etc., expresses strong disagreement with certain developments inside banks, but the shareholders of the same bank are silent or support these decisions, then in practice you see a disconnect which has become clear and which leads to tensions in society or confusion. And if the shareholders agree with the criticism, then they should speak up, which is not yet done sufficiently. What is required for proper decisions on banking activities is, I think, a combination of A, rules and regulation, and Stephen referred to it rightly, and personal judgment of what is still acceptable and what not. Personal judgment by not only senior management, but by many people who work themselves day to day in banks and carry out all these transactions. So a reliance solely on rules or solely on personal judgment will not lead to satisfactory results in our experience. It must be a combination, and that is not easy to achieve. In the current juncture in Europe, I want, however, to warn what I see happening recently. I want to warn against over-regulation of banks and banking activities, done with the best of intentions, but it leads to a labyrinth. And labyrinths are not easy to handle in practice. I notice a growing tendency toward new or intensified rules from a growing number of official institutions, either national or European, with the risk of overlap, more bureaucracy, and sometimes contradictory efforts. But that's not a good development. With regards to individual judgments, as I mentioned before, a balanced behavior by bankers with due attention to the need of ethical standards may be enhanced earlier in life, yes, I admit that, by their education at universities and particularly the business schools, the MBAs and Masters in Finance, etc. Very important studies, which should pay more attention to such matters that I mentioned, ethical standards, etc., rather than a more narrow focus on economic, legal, accounting, and bank technical subjects. That is being done to a certain extent, but more should be done. A typical remark about the Netherlands: the recent introduction, I think it's unique in this country, of a mandatory banker's oath is well intended and may have a favorable impact by making everybody in banking, because it applies to everybody, high and low, in the banking sector, make them more aware of their responsibilities and proper behavior. That is likely to happen. That's fine. However, I doubt, to be quite practical, whether it will have an important effect in practice. And I also refer to recent advice given by the Dutch Council of State, which was very negative on this kind of idea. There's more than an idea, it's a reality. Finally, one remark: the call for more ethical behavior in banking, those calls are justified. However, I admit how to achieve that in day-to-day life and practice is not so easy. But what I see as important actions, and you refer to it as well, is ex ante, a more critical selection by banks in their recruitment and training of bankers at various levels of the organization, not only at the top, but also somewhat lower, with more emphasis on character and past record of behavior of candidates. And ex post, a stricter set of penalties. I don't like penalties, but they may be necessary, or they are necessary sometimes. When later seriously negative financial effects emerge of unacceptable activities taken by a banker some time ago, but taking excessively risks, corpses in the closet, which then become visible. Yeah, if that happens, then the possibility of later clawbacks or bonuses granted in earlier years, that possibility is a useful device in this respect. And that will have an impact on, I think, on the behavior of people with sometimes bad intentions. I leave it with that. Thank you.